tuning into Talking Point. I'm your host, Neeraj Chan. The Talking Point today are the views of Mr. Hiren of Alchemy. He needs no introduction, and it's an opportune time to have him because we are on the cusp of changing dynamics on the global interest rate stroke money supply front. And we have to figure out whether the impact has already been priced in or are there nuances to this aspect as well. And then, of course, within India, what are the things that Hiren is looking at very closely? Hiren, great having you. Thanks for joining in.
Thanks, Neeraj. Thanks to be back on your show.
Thank you so much. So Hiren, let's start off with first the bigger overview and then kind of zoom in. We'll probably see the first of the 50 basis points hikes from the Fed in May. Maybe there'll be more. I'm sure there'll be more. I want to understand from you, Hiren. Do you reckon that when people say that some of this has already been priced in, is it really priced in, or some of these events, the impact is only felt after they happen because they are happening after such a long time?
So, my view, Neeraj, is that, the Fed last year was behind the curve. And then when they realized that inflation is really spiking, that they were behind the curve, and therefore there was the urgency to start raising rates, right? And I think if you look at very strategically, what the Fed has been doing is basically preparing the markets for higher interest rates, right? So we've seen a series of very hawkish comments from several Fed governors who between meetings come in and at an opportune point talk about probably not doing 25 but even doing 50 basis points, was in my view kind of trying to prepare the markets for an inevitable. So when the actual event happens, right, I mean, it doesn't come as a shock to the markets, and people kind of already priced that in very, very quickly. So I think if you're asking me about the first 50 basis point or the first 250 basis point price hikes, my thinking is that it's already priced in, right? And I think, again, there is a whole host of macro commentators who try to understand this language and the nuance of the language and so on and so forth. And, frankly, we are not that level of experts to try and figure out what is happening. But I think that one thing is very clear now is that, the amount of liquidity that was sloshing around and the ultra low interest rates that we've seen, obviously that has to change as the world normalizes. So also the cost of capital has to normalize. So also liquidity has to normalize, right? But let's look at, the last cycle. So when the global financial crisis happened, interest rates were brought down to zero, liquidity and central bank balance sheets were expanded. And then, again, interest rates went up, right? The first scare came in 2013, but the actual hike in interest rates only happened in October 16, right? And but when they settled back, what happened was that interest rates settled at a lower high than the previous high, right? So from the absolute low, we may see interest rates go up, but my sense is that given the kind of leverage that most of the developed world is sitting on, right, with debt to GDP ratios well in excess of 200 to 300% in the major large countries of the world. To me, it seems very difficult that they can do with much higher interest rates. So yes, interest rates will go up, but if I were to use the market technical terminology, right, interest rates are making lower and lower tops. And even if you look at the Fed balance sheet, while they contracted the balance sheet after the global financial crisis, but the balance sheet remained at somewhere around 4 trillion odd, right? So they did contract the balance sheet, and then kind of that liquidity stayed in the system, right? And we have so many other uncertainties today with what is happening in Russia and Ukraine. Already some people have started to talk about a recession in the US as a result of the inverted yield curve. So we don't know if now the Fed goes and hikes or tightens very fast, what may happen to growth. And therefore, at some point in between, they may have to stop again and reflate the economy, right? So these are imponderables. My sense is that, since we've been talking about this for a long time and the Fed has prepared the global markets by being very hawkish from being very, very dovish, right? It would be fair to say that it shouldn't come as a surprise to the markets if there is a 50 basis point hike. Let me put it that way, right? But again, there is enough, whatever history is available today to us, is that if the economy is doing fine, then I think that interest rate hikes and global markets have actually risen in tandem. So you've had, we looked at two other hikes, one in 2004 and then again in 2016, when from absolute lows, the Fed started to hike rates. And in both those periods, we saw that the US markets and the global markets actually gave positive returns over that period. Well, this time it could again be very different, but that's what at least history tells us. So if you ask me, I'm not at this point in time sweating too much about rising interest rates globally, because I think that if the economies have normalized, if post-COVID, then I think the cost of money also has to normalize.
Okay, and some of that might not be that bad an event, even though it might be slightly different. In which case, even this whole conversation of global investors leaving EMs in general, maybe India in particular, but EMs in general, started from October in a big way once the tone of the Fed changed. Now, my question to you is, because you are amongst those houses which has got a fairly large global investor base as well. What are your clients telling you about how comfortable they are staying invested in an emerging market like India? I mean, they might be comfortable with you individually and therefore they might be staying put. But in general, their thought on staying invested in India in the wake of the fact that the money supply is changing, the interest rate trajectory is changing, and to an extent, if the dollar were to strengthen more, then that's a bit of a negative for them too. How comfortable are they? What is your sense?
So I think you're absolutely right. I mean, when we talk about foreign investors, one thing is very clear. They do look at India as a place where they want to be structurally invested, right? Obviously, for many investors, they do look at what is the right time to allocate more to a country like India, right? And historically, if you see, people have their mental math in their mind. If interest rates are rising, then you don't put money in emerging markets, you go to dollar assets, right? I mean, those are things which are ingrained in international investors, so on and so forth, right? Also, I think generally foreign investors do not take a very optimistic view of India when especially oil prices are rising, because where India is in terms of 85% of the oil is imported, it definitely puts a strain on our balance of payments, on our fiscal situation. We've seen it in the past. However, this time there are a few things which are different, unlike in 2013, right? One is that our macro is not as fragile as it was in 2013, right? So, we have very strong FX reserves. And therefore, we have the ability, we don't see a problem on the balance of payment side, right? So, secondly, India has had record exports last year, right? We had $410 billion of exports last year. And exports are only growing. And I think after a long time, this government is thinking strategically on how to keep expanding India's competitiveness in the export markets. So if you see what the Commerce Ministry is now doing is that we are signing FTAs with so many governments, right? With so many countries, right? We did one with the UAE. We are now doing one with the UK. We have the EU representative here in India. We are talking about an FTA with Australia. So I think that it is not just India was always loved for the large domestic market and domestic stories, but I think this government is also thinking very strategically on how India should take advantage of the new geopolitical realities that we are seeing, and especially post-COVID as supply chains are getting rewired across the world. I think India has a great opportunity to win back some market share in exports. So the point I'm trying to make is that we're not as vulnerable as we were. And actually at $80 of oil, right? India was neutral because India's software exports at $80 are higher than our oil import bill, which is we were never in that situation for a long period of time. And given the fact that structurally we've seen all the big IT service companies tell us that we are in a structural growth cycle of tech spending around the world, and even if IT exports keep compounding at 12 to 15% a year, which is pretty much the kind of guidance that most tech companies have given, I think we are in a good place there. Fiscally, also, I think while we, the world has attuned to running large fiscal deficits, right? If you look at some of the larger countries, they are running higher fiscal deficits. So, historically punishing India for very high fiscal deficits, I think that's also a little bit out of the way because everybody has during the COVID period expanded their fiscal deficits to fund a recovery in this country. And I think there we should take heart from the fact that last year our indirect and direct taxes actually have done phenomenally well. If you look at the trend of GST, revenues, if you look at corporate tax, if you look at income tax revenues, our revenues after a long time, we are beating estimates. If again, I were to use the stock market lingo, at a macro level, our revenues are beating estimates that we put out in our budget. So I think, I think India is in a different place. So whether a rising interest rate scenario, rising commodity prices, yes, it is going to put some pressure on margins as we are seeing currently. But is it going to take India back to the backwaters of some tiny emerging market? I don't think that's going to be the case. And I think that frankly speaking, foreign investors also understand that the shock that they got in the Chinese markets, right, with the kind of regulatory burden that has been put on some of their most successful tech companies, which is where a lot of the excitement of global investors in China was, has also dampened the spirits a little bit about China and kind of elevated India a little bit more. So, as my senior partner, Mr. Junjunwala says, "Agar ladki sundar hai, to sab aayenge." So I think that we should, I think structurally India is in a good place. Yes, some of the investors do take a view that Indian valuations are a little bit expensive. Our premium within the emerging markets have gone up. So I don't think it's a question of if, but it may be more a question of when FIs come back. And really, have we been actually missing them? I don't think so, because the domestic investors have very well stepped into the shoes and have, the kind of liquidity that we are seeing coming into, it's a structural shift. So there are several structural shifts that we are seeing in favor of India, which is why, the markets are confounding a lot of skeptics that despite so many headwinds, the markets kind of held off reasonably well.
Do you believe they'll continue to do that again? Do you believe that it will get worse before it gets better? Or could it get better tactically because everything is priced in and then it starts kind of going off a little bit because valuations might be expensive because there might be earnings cuts up ahead and all of that? How does the pendulum behave to your mind?
I think my view is that there are two kinds of corrections that happens in the market, right? One is a deep price correction. I think the probability in my mind is lower that we will have a deep correction in India. But I think the second form of correction is more likely, and that is underway, which is a time correction, which means that the markets just hangs around in a broad range for a reasonably long period of time. And within that, we are seeing sector rotation keep happening, right? Something goes down, something else picks up the mantle, so on and so forth, right? So we had the largest sector by weight in India, financials, not doing so great. And there is constant pressure because of the kind of FI selling that we've seen. But there is something else that took the market up, whether it was Reliance or tech, IT services so far. So there's always some compensating impact of some sector, kind of compensating for correction that may be happening in another sector. So my view is that we probably will see a time-wise correction in the Indian markets till some of these macro things get washed out or get priced into the market, right? So, and on earnings, it's very interesting you bring up that point, and we did a little exercise that 70% of the Nifty companies, right, by weight, actually don't get impacted by higher inflation and higher commodity prices, right? Only 30% really get impacted. So, probably sectors like autos or cement, FMCG, that's where the margin pressure is really where it is, right? Financials, really, there is no direct impact, as we've seen the top few companies come up with results, and actually their numbers have done better, right? Another 15-17% is IT services. There is no real direct impact of that. They have their own issues in terms of wage hikes and supply side issues like attrition and stuff like that. But it's not because of higher oil prices or Russia, Ukraine, or higher commodity prices. So if you take 35 of the financials and if you take another 15, 17 of the tech, you're already past 53% of the Nifty. And then another 10-15% is oil and gas, of which Reliance is actually a very big part, which is actually a net beneficiary of higher crude oil prices. You've seen refining margins go up, right? So you again, and ONGC and stuff like that. So if you take another 15% out of that, you are well past 65, 66%, and 4-5% is metals, which is again benefiting from that. So you pretty much reach 70%. And we did a similar exercise for BSE 500, and there it is about 68%, right?
Oh, really?
Oh, yeah. So 68%, but yeah, will not get impacted. But in the broader markets, the impact is slightly higher because you have more manufacturing companies, more housing improvement and stuff like that, where margins could get impacted by higher raw material prices. So I don't think there will be very serious cuts at the Nifty level on earnings, right? There would be some cuts for sure, but there won't be a very large serious cut. And I think, maybe what we may not see was that we saw a lot of the returns when earnings were not doing well in India for the last 5 years, pre-March 21, right? Where we saw a PE multiple expansion in the market. Now the baton, in my view, has to be handed over from the PE multiples to earnings growth. So because of some of these headwinds that we are seeing on PE multiples, on earnings, maybe the market is in a holding pattern for some time. That's what I feel we're going to go through.
Interesting. We've done about 18 minutes, but I'll still take two questions, Hiren, if you have the time, and then we'll.
Sure.
Yeah. So
Please.
One is, so you are amongst the earlier voices who spoke about this manufacturing renaissance, right? My question to you is, because of this raw material input cost pressures, does that story get delayed a little bit in that, one, the companies themselves might or will face margin hits, and two, the much thought about capex revival might also get delayed a bit because both the government's coffers as well as some of the private sector coffers might be getting marginally impacted? I know you mentioned that in pure play earnings, 68% of the weightage doesn't get impacted, but the remaining 33% is the one which would probably be doing large capex because IT and financials anyways won't do the capex.
Yeah. See, I think so first coming, I think the manufacturing trend is much more structural and secular, right?
Yeah.
So I think that 2 or 3 quarters of margin hit is not going to impact the manufacturing story. And that is because, again, there is a certain level of structural deglobalization that we are seeing around the world, right? Where every country is thinking of becoming a little more Atmanirbhar than they were earlier, because, even during COVID, people realized that, you can't have all your eggs in one basket, because if borders are shut down, right, you see the kind of impact that companies have seen. So, for example, now a lot of the pharma companies which were importing intermediates are now thinking that let us make some critical intermediates in-house. We don't want to be completely dependent on China, right? And if you look at, there is a little bit of that discomfort with the kind of relation that even India and the world is having with China, that, people are not going to stop for 2 or 3 quarters because raw material prices have gone up. In fact, it is only going to accelerate the need for having domestic source of, secondly, defense, right? I mean, where we are, suddenly we have, geopolitically, India has had to play a very balancing act in the Russia-Ukraine war, because Russia is the biggest supplier of defense equipment and spares. So just think structurally, if the government has to think that we need to do more internally than depend on any one country. And now, obviously, this has been a big historical 40-50-year trend. You can't reverse it in 1 year. But I think you are seeing that more and more items in defense are going into the negative list, and more orders are being given to Indian companies, and we are seeing the order book swell, right? So I don't think manufacturing renaissance in India is at threat because of the current dislocation that we are seeing.
A delay, if not a threat. I didn't mean a threat, sorry. I'm asking, could there be a delay?
I mean, there could be a few delays here and there, but I think that the trend is firmly in place, right?
Okay.
And if you even look at where the capex is happening, right? So, for example, cement, right? I mean, companies who want to increase capacity are increasing capacity, right? But what we are seeing in cement is a constant M&A happening and consolidation happening, right? So, we had large capacities like Reliance and JP got sold to existing players. Now we are hearing about Holcim trying to move out, and again, some of the Indian players would want to consolidate that capacity, right? In steel, people who are profitable with the kind of money that they have made, or in metals as a whole, if you look at the pack, I think both Hindalco, Tata Steel, JSW, everybody is expanding capacity one way or the other, right? So they are not stopping at all. And the third area is renewables, where we continue to see, capex continue to happen, because that's where, we are heading. So I think the only area where you really need government support is in core infrastructure, because that's where the government is the only balance sheet which is still spending money, whether it is roads, whether it is bridges and on railways and so on and so forth, right? I think the private sector has pretty much vacated core infrastructure areas. We are not building thermal power plants anymore. We are not getting into, none of the EPC companies now want to get into BOT like the rush we saw, a decade ago, right? So I think the only thing is that, government will continue to play a pivotal role in hardcore infrastructure building. But the rest of the CapEx, whether it is electronic manufacturing, whether it is pharma, specialty chemicals, intermediates, auto components, that's not going to stop in my view.
Got it. Okay, Hiren, last question so that we don't take too much of your time. If you can tell us from where we are right now, where is it that you're taking really large bets in your portfolio? What themes? And where is it that, due to either liquidity constraints or your size constraints or otherwise, you're taking smaller bets? You may want to take bigger, but you're choosing carefully. So where are the large bets from Hiren, and where are the micro bets? What pockets, what themes?
So I think our large bets, continue to be in consumer discretionary, right? Okay. Not the staples, but the discretionary, right? So post-COVID, what everybody is talking about is the opening up trades, right? All sectors. So if you really look at consumption in India, what's happening is that consumption at the higher end is booming. Consumption at the lower end or lower ticket size is really got impacted because that's where the impact of inflation and price hikes is the highest. And obviously demand at the bottom of the pyramid has got impacted because of 2 years of COVID. People have lost incomes, people have lost pricing power there. And it's going to take some time before people rebuild their incomes at the lower end. So where we are focusing are on areas of premium consumption, right? So if you look at jewelry companies, if you look at liquor, right, we are very bullish on the liquor stocks, right? Or hospitality, right? We don't do airlines as much because it's a very volatile industry. But everything where people are spending back with a vengeance because what they've not been able to do in the last 2 years, and where incomes at the top end have not got impacted, the premiumization is only increased. That's where our big bets are. Financials obviously continue to be a big bet, but post-COVID, we went underweight in financials. And in financials, my view is that we've narrowed down on companies where we think that their business models are digitally superior. Right, so we got a lot of flack for going underweight financials during COVID, but when we rebuilt our investments in financials, we were very clear that I don't think that the leaders of the previous cycle are going to lead in the next cycle. So we moved away from the HDFC Bank and Kotak, and moved, there's only one company that I think from the previous cycle which will continue to lead in the next cycle because of their digital capabilities is Bajaj Finance. So we continue to be invested there. And then we moved our banking exposure to ICICI Bank, which has again outperformed HDFC group as a whole. And that continues to be the case even as we speak. And now slowly the market's realizing that probably there is merit in thinking differently when it comes to lenders, right? And I also believe that the sector's got a little bit derated because the investors are trying to grapple with what the fintechs will do, because that's, while on the liability side, the banks are very well protected, but on the asset side, there are parts of the value chain which are getting disrupted by new business models, right? So on financials, we took a slightly different view than what the consensus has taken. And we've bet on companies where we think not only these companies are operationally great, but where also their digital capabilities are way ahead of some other people. So that's one bet. Coming to the smaller bets that you talked about, where, so, the same thing, manufacturing, whether it is a combination of API companies in pharma, or manufacturing companies across. I think one area that is very interesting, which I think will come back, is agri inputs space, right? Because I think we are seeing a global inflation in agricultural product prices, which means that demand for agri inputs is likely to go up. So players like PI, etc., will do phenomenally well, right? So we're betting on that entire complex of API, specialty chemicals, agri inputs in the manufacturing space. We obviously have exposure to electronic manufacturing as well, which we think is a secular growth theme. So we're doing that. And then we've done a little bit of interesting stuff on the new age, where, I know that was something which divided a lot of people on the street. But, for example, Angel One is one company which has done phenomenally well as a platform company, right? Nykaa is another one which we bet on. I think some of these companies are interesting in the way they are growing, right? At 30-35% a year, where they are using digital and technology as a differentiating factor in many of these businesses. So I think a lot of the bottom up we are doing there in those areas, in manufacturing, in new age companies. And then I talked about our big overweight in consumer discretionary or opening up trades, right? That's where we think money will be made over the next 2-3 years. So I think the last thing I think COVID was a turning point in the market, right? And I think that what I'm seeing in the market, and then obviously tech. Sorry, I forgot to say that we are overweight IT services, despite the current correction that we've seen in the market. But within IT services, we took a very different bet. We bet on ER&D companies. So we, as you know now, we had a large bet on companies like Tata Elxsi, L&T Technology Services, LTI. I mean, but largely in the ER&D space, we see a lot of structural growth tailwinds there. So I think that's where we are. And, it's very difficult to kind of, you got to take a long 3-5 year view. This kind of sector rotation, you can't keep changing your portfolios when you're investing for the long term. But I think we've taken cognizance of the big shifts and trends, from staples to discretionary, within technology, from run-of-the-mill software to more ER&D companies, in financials, from just pure high-quality, lenders, franchises, to high-quality plus digital as a mix. So those are the shifts that we have made, as we navigate a lot of these disruptions that we are seeing in the investment landscape.
Hiren, you gave us a lot of time. Thank you so much for that. Lovely talking to you today and getting a slice of how you're thinking. Much appreciated.
Thank you. Thank you so much.
The pleasure was ours. And viewers, thanks for tuning in.